Hello everyone, welcome to the Black Bull Markets webinar today on the 15th of March, 10 a.m. New Zealand time, evening time on the 14th of March if you're listening from Europe or before the time zone shifts. We are, of course, in a very topical webinar content situation at the moment where we'd scheduled this in our calendar, knowing of course the ongoing volatility in gold, and especially after the last 7 days action with the banking sector, ever so more relevant now. So it's fantastic that you can attend. We hope you enjoy the webinar, and as always, please do continue to ask your questions or do comment if there is anything you would like me to stop and recover or go over. If you're unable to hear me or see me at any stage of the webinar, please do let me know as well, and we will kick it off. So essentially we're looking at gold at the moment, of course, and this the gold of course through the weekend had a gap to the upside of about 100 pips rather, and as you've seen, that rally has continued to go higher to the upside. Monday's market open stopped around the 1895 mark, and then we had a bit of a retracement to cover the gap, which is always a positive sign when you do get a gap coverage very early on in the market session, because what that means, it shows you that liquidity is apparent, and that's also a nice trade if you're actually watching the market open on a Monday following a lot of weekend activity. Of course, you can't trade gold on the weekend. You can track the futures, but you can't trade the gold on the weekends. On Monday when the market opens, or Sunday night, you generally get that gap, and as the gap forms, it forms space for a support level, a near-term support level, and you get a gap coverage that would have covered at 1869. And of course, as you can see now, we're a good $30 an ounce higher on gold. Touched 1913, which is a very key resistance level in gold on a short-term basis. And if we switch back to our 4-hour time frame, you can see exactly why that is. If we go to the left here, see a large confluence area dating back into January where we went up to 1957. Of course, a lot of pressure on gold to go and attack $2,000 an ounce now. So it's a general consensus, and through this webinar we're actually going to discuss what you should be looking at in terms of the fundamental sphere of trading gold, trade sizing, and also economic calendar based market events that could determine and help your understanding in where the long-term or medium to long-term direction of gold is heading based on all the risks. So first thing we're going to discuss, I guess, at this stage of the webinar, what factors influence gold. As you can see on the time zone here, we're GMT +2 for reference. So this time is showing just after the market crossover, or the settlement time. So we won't actually get any live prices for gold for another hour, because the gold market opens has a 1 hour break essentially, unlike FX, which is ticks on through the 24-hour clock. So you do get a break in gold trading. A lot of that is due to settlement. So for markets to begin settling their trades, as gold is priced in US dollar, you do have a lot of trades in foreign currency that settle during this time. That also presents a prime opportunity for trading after that hour, when all of those trades have been settled. So it's going back to those initial factors that influence gold. So firstly is your underlying economic condition of the global economy. That could be a reflection, saying today's economic climate of persistently high inflation. The cycle that we're going through at the moment is where over the last 12 months, of course, due to COVID, due to the spending sprees of governments globally, money printing, low interest rate environments, high investment appetite, we saw a lot of spending, and as a result, of course, inflation hit in the next cycle, and that inflation has been pretty persistent. As inflation hits, there's and interest rates rise, there's more of an appetite to buy gold, for gold to travel higher. And that if we switch to a higher time frame, this gives you a good example of the picture of trading activity in gold. This is a weekly time frame, so it does show you a nice lengthy historical charting of gold going back to 2021. And you did have a dip late 2022, of course, just as interest rates were starting to rise, and of course that came down. But gold generally prices in inflation, so it is a hedge against inflation. What that means is, if you do have persistently high inflation in an economy, or expectations for high inflation, gold travels to the upside. Why is that? Because gold's a non-interest bearing asset. Investors, the old saying, hold gold if you want to be safe. It is a store of wealth, a hedge against inflation, which means throughout economic cycles of high inflation, low inflation, gold generally holds its value. So that's the reason why you get a flock in gold, and that's the first thing you should look at when you're trading gold, or which direction you would want to see the expectation for gold to be in, is to assess the underlying inflation levels of an economy. And that could be looked at through the CPI index, for example, for the US, or the retail sales index, which gives you the general inflation tracker across a basket of commonly consumed goods. Now, going back to the charts, how do we play this out? Well, we then know that our outcome, or the likelihood of gold traveling higher, is probably higher or greater than it going lower. If what we do then is we establish, what I generally do, so I look at longer term time frames and I establish key support and resistance levels. So it's the first thing I'll do when I look at a chart on gold. So the strategy to play is, well, hey, let's have a look at gold. Let's see where our support and resistance levels are, where the highs and the lows are. It's the basic starting point, building on from that fundamental analysis. So we can see that for a long period of time, 1680, this level that's pointed out with this red line, just above 1680, was provided support for multiple bottoms. So ever since, of course, COVID did happen and the lockdowns occurred, and the appetite for investing into indices was apparent, we saw a lot of volatility in gold, and 1680 held very strong as a support level. Only recently did we see that support level break, and that forced the new gold a low at around 1617. So it's about 65 or 66 dollars odd short of that previous low. And if we then go to the left of our charts, always look left to find the nearest support, you can see that matched up perfectly with the close of these candles back in early March 2020. So support always lies on the nearest low, that is a historical low. This is a weekly chart analysis, so this does give you a picture of longer term support levels. If you wanted to get a bit more savvier about it, you can then skip to the shorter time frames and see where the market is moving with respect to those support levels. So from what I can see here now is that we did have a rejection around the $1,800 an ounce level, and that was very recent. Of course, that was the nearest term support level that is formed, and from there a move very recently back up to 1870, which was a previous resistance broke 1870, has now rallied almost 5% from that level, and that was only last week. Remember that's last Friday's close, this candle. So that Friday anticipation candle, I'll call it, was based upon a lot of the speculation that we're going to get a weekend gap to the upside and the possibility of gold moving forward. Now, all of those technicals played in when you got a clearance of 1870, a close above 1870, which was yesterday's candle, which finished at almost $1913 an ounce. And now today's candle showing a bit of a reversal, but potentially another opportunity should these fundamental should the fundamentals stay at bay and investor appetite for gold continue to push gold higher. So if you're looking to long gold, it's about finding the right place to long gold, and how to identify that, because a break of 1913 being on the cards could then go and attack that next high at 1960. So that's basically the analysis on the daily chart. If you are going to place a trade, there are a few options to take. Now, impulsive trades is something I'm definitely not an advocate for. For example, impulsive trade meaning if I'm looking at a chart and it's going up, oh yes, let's place a trade right now. Not so much. I'd more like to take a step back, consider my options, and look at what a good price is to enter this market. Now, if I'm looking at gold at the moment, and I'm sure that if a break of 1913 would spark another level or another rally up, what I'd like to do is place a buy stop at 1913 with a take profit at 1960, and that would give me complete coverage of that candle here, which closed at 1913. So it's the bottom of this close here, or the low of the candle that formed on early Feb, probably. I believe it was the 1st of Feb. So what you do is you can simply set an order. So you can tools, new order, or F9 on your keyboard, and put a pending order, a buy stop, which is above the market price. And just for this example, we're just going to stick with 0.1 lots, which is essentially $1 per pip value move. And the price I'm going to set is 1913.99, which is essentially what I've got marked on my chart, just for reference. The take profit level will be 1960. So we'll put it as 99, just for argument's sake, for mathematical purposes, to work out appropriate risk management. And the stop loss, so in this case, it looks like I am looking to make a total pip value of about 47 pips. $47 is what I'm aiming at. So I'm going to be risking a 2-to-1 risk to reward ratio. If you've been following my webinars in the past, I'm a big advocate of the 2-to-1 rule, which means for every dollar I'm risking, I'm looking to gain $2 from that. So my stop loss will be half of my take profit value. So if it's 47, we're looking at 23.5, if my maths serves me correctly. If anyone cares to comment to correct at any time, please do let me know. But I believe, it's 23.5. So what we're going to do is minus my entry level by $23.5 value in gold. So we're going to go down to 1890.49. So let's input that as my stop loss level, and we're going to place. And of course I can't place because the market is closed. So as I said, the market opens in 45 minutes. So when that does open, that order will trigger through. So I'll place it again. So that is essentially the reason I did that, was going back to my point. When you're looking to trade, impulsive trading is probably not something that would suggest, I would suggest personally, it's looking at the chart and looking at a position that you'd like to place. So my position would have been triggered here, my take profit here, and my stop loss at 18, $24.50 value to the downside. So 18.90. So essentially what that means is that I have a trade placed in the market. My assumption is a 1960 take profit level, and if I zoom out, I see that is the high there. I've got an appetite for risk for buying gold. If you look on a weekly time frame, you can see that 1960 is also a key resistance level which formed back in 2020 or late 2020. It was a multiple top, and it's definitely a key level on gold to consider. Now when you see gold on a high time frames, you can actually see that it moves beautifully within these ranges, and that's why I like to keep a clean chart when looking at gold, and essentially draw out my range bound ranges based on support and resistance to understand the market. What's interesting though on gold is that 1960 has held on multiple occasions, but it has broken it in the past, and that break forced the all-time highs, or the highest level gold has been to 2060, around the 2060 level. So it is not an impossibility for it to travel there again. So that if it does reach 1960 and hits a take profit, you could indeed place another limit order buy stop at 1960 to go even further. When there is a strong buying appetite for gold, it does move very fast. So another thing to consider. That's one strategy. Now, another strategy is, if you saw my chart right at the beginning, I had some moving averages on there. And that's another trending strategy that I like to use on gold. I would generally put a 21-day, and I would also put a 50-day moving average. Now, this, in my opinion, works well when looking at a market like gold, because it does, as we've seen in that previous diagram, it works very well for markets that form good support and resistance levels and have some sort of trending pattern on that short to medium chart. So as we've seen a burst up in gold, we can then go to a daily time frame to try and get a better idea of what the moving averages think of this movement. But what it does say is pretty interesting, because essentially the rule with this is when your 21-day crosses above your 50-day, generally have a bullish trending market. Now it's interesting here because the moving averages actually contradict my previous thoughts of going up to 1960. So it's a bit more conservative about that decision. Why is that? Well, we did have last week's the February fall, the sell-off in gold, sell-off to an extent, from around the 1870 mark to the 1804 mark, so about $70 odd of a move, and that would have caused a crossover or a sell signal here in gold. Now these moving average crossover indicators generally they're based off of a lagging trend. So this could be a capsule move here where we could potentially get another crossover. So if I'm looking to buy gold, I might not buy gold until I get another crossover between my 50-day and my 21-day. However, that initial decision I made to buy gold at 1913 with a take profit at 1960 may then be counter-checked by this secondary strategy check where it says, hey, wait, hold on, you maybe don't want to buy gold based on this moving average crossover that we have in place. If we go and look at historically how this moving average indicator works, right? If we go historically and see the performance of it, we can see that the 21-day floating above the 50-day from November last year all the way to very recently, in fact, just a couple of weeks ago, has worked very well. So what that means is essentially if I was to buy gold upon this crossover at 1681 on the around mid-November, and buying the dips, as it were. So essentially, every time gold touched gold touched the 21-day moving average, that provided me with a dip buying opportunity. And effectively, you're holding a long position from the beginning of the crossover to the end of the crossover. So if you count the pips from crossover to crossover, that would have been an 11% move, which is almost 1900 pips in gold. So that's a good trade. And if you follow a moving average crossover strategy, this is a daily chart, remember, right? So that the previous crossover arguably was right here on the 6th of September 2022. And if you shorted that, because it's the flip side on this occasion, that's when you're 50 days above your 21 day, that would have generated you 745. So this is a swing trading strategy. And the reason why I like to look at this for confirmation, because this does give me a general idea of where my trend is. And it's another confirmation in that forms the basis of short-term decisions. So this strategy actually says, wait, hold on, don't buy gold. Wait, if you do want to buy it, wait until you get a crossover, or potentially short it back down to your 50-day moving average, which is pointing at a short. So in theory, this is saying that the market's going to come back down to 1865 and then go back out of those, between those two moving averages, what's the crocodile teeth as it's sometimes dubbed, and operate back below 1836 and travel down to 1808 if that theory does hold. So sometimes it doesn't work, because you do get spikes and you do get confluence areas, but most of the time on gold, especially in trending markets, it works very well. So that's definitely something to consider. Okay, so just seen a few questions come through. I'll just go and answer. So we've got what is the rule again for the 21 moving average? So okay, we'll just go back and explain this again. What I have is a daily time frame gold. I've drawn two moving averages. Now the purple line is my 21-day moving average, okay, and essentially that encapsulates 21 days of moving of price movements, and it plots the trend. The blue line is my 50-day moving average. Now the reason these two couple well together is because I can identify buy and sell positions, or buy and sell trades based off a crossover. So some people simply, you know, in a 12-month period would only place 1, 2, 3, 4 trades in a year, if you're just following this strictly. But for me, I like to use this for confirmation to see where my trend is. As I said, if I was looking to buy gold now as an impulsive move and potentially look for a short-term profit, but hey, if I look at this moving average confirmation, it actually contradicts that decision and says, wait, because we've had a previous crossover and we could expect a reversal back down to the moving average areas. Yeah, so hopefully that answered your trade. Can you your question, can you please do US30 after? Unfortunately, this webinar is just for gold trading. However, we will do another webinar for the Dow Jones. Of course, we saw I believe on Thursday, it was a 245 pip close on the Dow Jones to the downside, and that was in anticipation of the SVG bank collapse, which of course failed, and hence the reason for this move as well in gold to the upside. So markets are now kind of pricing in all of this action. They've become a bit toppy, and potentially could come back down to that 1860 level if nothing else well, any other banks unexpectedly collapse. So yeah, please feel free to ask any more questions that you might have on gold. That's my analysis really of the moves that have happened of late. And even if you skip to a lower time frames, of course it's closed now, so we can't see live market action, but we have had a bit of a cool off around that 1903, 1910 level. Of course, we've gone back to the daily time frame, identified 1910 as a key support level, and a move above 1910 you have 1960. Still a way to go to hit 1960, but if this impetus continues, for sure. However, if you skip back to those moving average indicators, it does contradict that and says we could reverse, so hold on if you're looking to buy. Okay, do you have a scalping strategy on gold? So I personally don't like to scalp gold. Probably if you see this chart behind me is the reason why. I mean, I would like to look for moves that position nicely on higher time frames that I can then go down to the 4 hour or the 1 hour to place to trade on. And that will, I generally look for $20 to $30 move in gold as a take profit target. So that could occur during a few trading days or during a week. However, if you are looking to scalp gold, Black Bull Markets is actually a good place because our spreads are very tiny on gold. Start from 10 cents. I saw them go down to 7 cents yesterday's trading. So scalping gold means you need good spreads, tight commissions. It's a place to be over here. Fantastic. I'll leave the room open for a few more minutes. If anyone does have any questions, please do fire them through. Do hope that you sincerely hope that you've enjoyed the webinar and that it's been useful. Of course, you've got to trade safe when you're looking at gold because it's can be a very tricky market, especially if you get yourself trapped in some bad positions. You don't want to be holding them too long. You want to be looking at hedging out with other assets if you are in a bit of a drawdown. But yeah, okay. Hope that helped everyone. And if there are any questions, I will leave my email as a follow-up. This webinar is recorded, by the way, so you can access the recording on our YouTube channel, as well as all the other great content we produce and the other great webinars we produce. But hope this helps. Wish you all the best of luck with your trading and have a great one. Thank you for attending.